Hello, swing trading stocks watch list. How to select stocks with long uptrend lines. Well, we have an example of watch list here, and is 2025 large cap watch list stocks for us. And we started with a longer watch list. So at first, when you are looking for stocks, at least the way I did it, you will know right away that they are long trend lines unless you are using some technical analysis to filter. But if you have Charles Schwab account, under Charles Schwab in the top bar, you'll click on search or research, and underneath that you will click on US stocks, and you will click on stop screeners. So when you do that, you'll have a page similar to this, and I like to click on basic and select market capitalization and exchange. So within market capitalization, you will select large cap and New York Stock Exchange and NASDAQ. By doing so, we narrow down the pool to 337. So, and then you will be able to pretty much download it as a CSV to your spreadsheet. From that point, with your 300 or so stocks, you can set up some other parameters to eliminate some of them. One parameter will be if it's not a corporation is out. You don't want L.L.C or L.L.P, limited liabilities, in the mix. Just corporation. So corporation will have Corp, Inc, CO at the end of the company's name, and you will analyze the stocks. So when you analyze it, first you wanted to know for how long they have been public. You can find that as well on Charles Schwab. When you click on the company chart on Charles Schwab, you'll be able to find how far it went. And I just like to copy that and add it here. Then you'll analyze the chart. To analyze the chart and know which one are trending or upward large cap stocks, I like to use Think or Swim platform. It's free if you have Charles Schwab account, and I use it to analyze chart and to trade stocks. I do that in Charles Schwab. So and today we are going to use the example of TSCO. So TSCO, you will go to maximum monthly chart to start. So under monthly chart, you'll be able to have a big picture of the chart, and then you'll try to connect the higher lows, the obvious higher lows from the past toward the price. The price is on the y-axis and the date is on the x-axis. So by tracing, you'll try to connect the first two and see how far that can go. This one, for instance, is going across it, so we do not want that. Then you'll come down. You are trying to touch the valleys of the mountain multiple as much as possible. So this one comes down to here. Is quite low compared to where the price is right now. You can try to trace it again. So pretty much you are trying to go to the price, and you are trying to see if you can get closer to where the price is right now as well. So this one can go from there, and it's not touching base with this, and is skipping all of that to come here. Therefore, I'm not going to use it. I will go from that green and is not going there either. And when you are tracing, you retrace that one, you will try to start with pretty much the bottom of the mountain, and the red bar, or if the green bar is lower than the red bar, I can use that green bar as well. So by tracing it like that, by looking at the monthly chart, you'll have the feel of the wave that the chart is creating, and you can look at it and say this is uptrending, because the beginning at the left, the price corresponding to it is very low compared to the price right now. So there is an increase in price over the years, and the chart is zigzagging but not too much, and is doing that going up, and the top of the mountain is higher every time. So therefore this is uptrending. So you have higher lows and higher highs as well. So this is uptrending, and in your spreadsheet you can mark it as an upward. If you have a lot of jagged teeth, you can put growth and dip. I like to mark it either upward or growth and dip. So now that you are done on maximum monthly chart, you can come back to maximum daily chart. That's the chart you will use to analyze stocks, to trade, to buy stocks, to sell stocks. So for the analysis, you don't need to zoom unless it's close to where you want to buy or close to where you want to sell. So we are just going to look at it from far like this. You can have multiple years in front of you as well. They are delimited by dotted lines, and here you can adjust the lines if you think it didn't is not close to the valleys that you try to touch, the lows that you try to match or to connect. If it's off, you can adjust it. So now to do your analysis, you'll compare what is going on to those lines that you trace. So you can see that the lines that we trace, only one is showing up clearly. Maybe one is down there, but you'll pick few of those to be where you want to buy. With our long up to long swing trading strategy, we can decide ahead of time where we want to enter the trade. Our entry point is going to be one of those lines or few of those lines. So far, we color code one of them in purple. That is the valley that we like to buy at. That is where we have multiple touch base of the chart. So now your analysis will be to compare where the price is to where you want to buy if you have not bought it yet. And today is September 28, 2025. The market closed on Friday. Today is Sunday. We are doing the analysis after the market closed. So the price went up on Friday because the price is color in green and the bar is green. So that means the price at the end of the day was higher than the price in the morning when the market opened. The price went up that day. But when you are looking at the whole things there though, is dropping. You can see the pattern there, the direction that the chart is going is dropping. So we don't know if it's coming down to the valley line or not. It reached a new high not too long ago, went up, and is dropping. So, but where it is, we are not going to buy. So that's how we select stocks that are uptrending, to add to our watch list. So you'll start with a large 300, and you will analyze each one of them and pretty much use your own score, to rate them, to rate them, and later you'll pull from this list to another list, the one that score higher, And from there, if the list is still a large one, you can narrow it down. And I found about 70 stocks to be the right number for me to analyze within an hour every day, if I have the time to do that every day. So, and here we have about 79. So you can do that. And pretty much we are going to take the second one, TYL. Their analysis on a daily basis is going to be to look at where the price is. Those are not higher on my spreadsheet. That means I didn't buy, I have not bought them yet, or if I purchased them, I sold them. But like this, we are seeing the arrow there, the one pointing up shows where we bought, the one pointing down shows where we sold. So when they are sold, the highlighted come off of our watch list. So the one that are now highlighted are the one that we do not have in our portfolio. So to analyze those, we want to see, compare where the price is to our entry point. So this one, the price went up on Friday, but in overall is going down. So it's on this support line, which is supporting the upside wall of the mountain. But again, it reached a new high a while ago. We don't know if it's going to rest there and go up again, or if it's on its way down to the valley. And that is all the analysis we are going to do. It's far from where we want to buy, therefore it's not a buy. And then we will move to the next. So that is the analysis you'll be doing. Once you have your watch list of stocks, you'll just go through them very quickly. And when you find one that is close to your entry point, then you'll zoom in to see if you are seeing higher lows. If you are seeing higher lows, you wanted to see how many you saw. If you have about 3 or so, then the next green bar that follow a pullback, you can buy some share if you feel like buying. But before you buy, it's good to compare how the price behave around the trend line you want to buy at, compared to the last time it touched base with it, to see if it stayed there for a while. For instance, it touched base here, went up, came back to touch base, went up, came back to touch base before it's ready. So when it's touching base the first time, you'll wonder when it start going up from there if it's okay for you to buy, knowing that it could touch base 3 times there before taking off. And if you are okay buying it, then you can buy, knowing that you might stay in it a little longer. And if you are okay with it, you're okay with it. So those are decisions you have to make before you enter the trade. And once you enter, when you are doing your analysis, it's going to be to compare where the price is to when you want to exit, which is going to be the next high. And when you get to that area, you'll compare, when it reached the new high, you'll compare how it behaved the first time it reached the new high after leaving where you bought it. So the first time it reached it is going to be somewhere here. It created a few new highs before it was done. So that just tells you that when you reach a new high, your best bet is just to get out. If this is the the new high and it goes all the way down, chances are if you buy the first time it reached a new high, you just sell it there, because again, it won't take long before it might be done. It does not linger too much at the peak. We are seeing it. So, but those are not decisions you have to make based on the type of stocks you are trading and how the chart is moving. But again, having your own watch list, that is just a watch list you are going to be analyzing on a daily basis. If you can analyze it on a daily basis, that is good. But with large cap stocks, even if you don't analyze it on a daily basis, they do not fluctuate too quickly. So you can still, some weeks later, you can still see the stocks around the same area that you are targeting. So therefore, you have the flexibility when you have a busy schedule to get to join the train, even if you didn't catch it where you are planning. before. But having your watch list, you can just analyze trade from it all year around, and you can just put some notes on some of them that didn't really work well with the strategy you are using. That way, at the end of the year or so, you can take them out of your list, go back to your master list, analyze them, and see which one you do not have on your list that you like to give it a try and add it to your list as well. And go again another year. If you want to go 6 months, you want to go 1 month, whichever. But you have to actually analyze the stocks to see if you can understand the chart. The chart is, your strategy can work well with it. You cannot change the stocks, you can change your strategy. So it's good to find stocks that work well with your strategy and have them in your watch list. And from that point, trading the same stocks over and over and over, in my opinion, just allow you to get yourself familiar with those stocks and be able to take some risk to see how you can push your boundaries or the boundaries of the strategy you are using as well. But just start small, 1 share at a time. With this strategy, even if you start with 1 share at a time, if you are buying it at 371, for instance, and you are selling it at 662, for instance, you'll have a good margin right there. You know, almost double your profit right there. Yeah, double how much you pay for it. So, and yeah, but you can just aim $1 profit. Assuming if you buy 1 share, you'll have enough profit to pay your brokerage fee. And if you can have $1 profit, that's all. That way you can stretch your account. If you have a small account, you have a small investment in your account, you can stretch it. Test it, your strategy with different stocks in your portfolio without allocating a big chunk of your investment to one trade. That way you can see stocks that are working well with your strategy. You can practice more your strategy to see if you like it, if it's in correlation with your personality type and your risk tolerance as well. And there, that way you can practice the strategy. You can trade often as well, and you can see what is working, and you'll have more incentive to save more money and put in your account every month or so, each time you can afford. And you don't need to necessarily trade stocks that are this expensive when you start out. When you are doing your filters, you'll be able to even if you select all the prices, you'll be able to curate your spreadsheet to just have stocks that are within a certain price, that if $40 a month is all you can save to put in your account, that is okay. You can transfer $40 to your account. I use Charles Schwab account. You can put $20 in it. So, and if that's $20 you can save that month, and you have stocks that are within that amount, and that are well set for you to buy one that month, you make the purchase. So now you can pay your fees, your brokerage fees, and have a profit. Even that's $1, it is a profit. Once you have a proof that your strategy is working and the stocks you are trading is comparable with your strategy, and you have at least $1 profit, it does not mean once you have a profit of $1 you will sell the stock, but you have a proof that you have at least $1 profit. Also, then you know that to make more profit, you just need to buy more share of that stocks. There is no point of taking any unnecessary risk if you do not like those risks. Just to buy more share, to make more profit, you just buy more share and repeat the same process. That way you'll have a sustainable process, a repeatable process that you know that, over time you'll grow your account with the money you are putting in it and with the profit you are generating from your swing trade as well. And little by little, you have a stream of income beside your job. Your job will provide the funding that you will use as a leverage to trade. You will use a portion of your paycheck to invest, to swing trade, and have some profit from those swing trades, which, over time, the hope is can be more than how much you are making from your job. But let's start small first so that we do not unnecessarily lose our money. Thank you so much for your time. We thank you very much for all your comments, and we thank you very much for watching our videos. We thank you for subscribing to our channel. I'm Afiavi Liberman, creator of Liberman Consulting L.L.C YouTube channel, and NYSE.com, our blog. On our channel and on our blog, we share different ways to save money and different ways to make money to reach your financial independence, where you do not depend on an employer to provide for your family. And swing trading is one way to make money. Just start small. It's not get rich quick. It's having options that you can tap in if you need it. Otherwise, it becomes your retirement account. Thank you. Why not? You can even tap into it. If you are doing it in a brokerage account, you can tap into those profits to buy a rental property. You have it there. So thank you. You can swing trade in your Roth IRA, or you can swing trade in your brokerage account. In your brokerage account, you will pay tax every quarter, estimated tax. And that's what I chose to do, swing trade in our brokerage account. Although I have traded and invested it before in our Roth IRA, but now to grow our joint brokerage account, that's where I'm swing trading. We pay tax on it, but I think it gave us more flexibility to touch the money when we need to. It's not in an investment account that has all the government rules when you should touch it, how much you put in it a year, when you should touch it without penalty, and so forth. It's okay if you have to do it in a brokerage account and pay tax on it. We live in a country that tax is not going away, so I'm not trying to avoid it. Prefer to have access to my money, and that way not asking the government when to access it or prove that I can access it. So I prefer to do it in an account that I can pay tax on it. But if you prefer to do it in a Roth IRA because you don't have a plan to touch it just yet, that is okay as well. The Roth IRA is tax free. Just don't trade L.L.C in your Roth IRA, because if you trade L.L.Cs in your Roth IRA or invest in L.L.Cs or in your Roth IRA, you will pay tax on those. Your brokerage firm will file tax on them, and if there is tax due, you will pay tax, or you might trade some stocks for them to use that money if you don't have cash in the Roth to pay tax on those. So that's why I like to take L.L.Cs out of my watch list. I have experience with them, and I had to liquidate some stocks in my Roth IRA that I have profit on to pay some tax on an NLC that, one, didn't pay me anything. They have higher dividend, yes, but they didn't pay me anything. But then when they file bankrupt, all of a sudden they have a good profit or so to report that after the brokerage firm filed that, I think it's like $990 or something like that form that they filed that was due around $2,000 or so in taxes from an NLC that I invest in for some years. earning dividend income and not much more, and clearly those dividend income didn't total to 2,000. So, and they filed bankruptcy, so that means I couldn't sell those stocks either. Then I had to sell some other stocks and use the profit to pay off the tax, or to have it available for just so I to pay that tax. So that's why I don't like, even if those LLC have higher dividend rates, I just cross them off of my list. But again, it's personal choice based on personal experience. So thank you so much for watching. For more of our swing trading related videos, will you please check the playlist in the description of this video. Thank you for your time.